Banks are now offering 50-year mortgages, and they're marketing them as the solution to housing affordability. Lower monthly payments sound great, but here's what they're not telling you. You could pay over 3 times your home's purchase price in interest alone. Today, we're breaking down the math behind this mortgage trap, comparing it against traditional options, and showing you 3 smarter strategies if you're struggling with affordability. Let's start with the numbers that banks don't want you to calculate. On a $400,000 home with a 50-year mortgage at 7% interest, your monthly payment drops to around $2,530. That sounds manageable compared to a 30-year mortgage at $2,661. You're saving $131 per month, which seems like a win. But here's the trap. Over 50 years, you'll pay $1,018,000 in total interest. That's nearly 3 times the original loan amount. Compare that to a 30-year mortgage where you pay $558,000 in interest, or a 15-year mortgage at just $239,000. The monthly savings evaporate when you see the lifetime cost. Now let's talk about equity building, because this is where the 50-year mortgage becomes truly problematic. After 5 years of payments on that 50-year loan, you've paid $151,800, but only $26,000 went toward principal. You've built just 6.5% equity. On a 30-year mortgage, you'd have 11% equity. On a 15-year, you'd have 24% equity. You're essentially renting from the bank with a tiny ownership stake. Banks are pushing these products hard right now, and their marketing focuses entirely on monthly affordability. They'll show you how much house you can qualify for with lower payments. What they won't show you is the amortization schedule for the first decade, where nearly 90% of every payment goes straight to interest. They profit enormously from extending your loan term. So when does a 50-year mortgage actually make sense? The honest answer is almost never for wealth building. There's one narrow scenario. You're in a high appreciation market. You have irregular income that makes refinancing likely within 5 years, and you need to get into the market immediately to avoid rising prices. Even then, it's a calculated risk, not a sound financial strategy. Let's explore 3 alternative strategies that actually build wealth. Strategy 1. The aggressive down payment approach. Instead of stretching for a bigger house with a 50-year mortgage, buy less house with 20% down on a 30-year mortgage. On a $300,000 home, instead of $400,000, your payment is £1,196 with a 30-year loan. You're paying less monthly than the 50-year option and building equity 3 times faster. Strategy 2. The income acceleration method. Keep renting for 18 to 24 more months while aggressively increasing your income through side hustles, certifications, or job changes. Use that time to save a larger down payment and qualify for better rates. A $50,000 income increase changes your entire mortgage landscape. You can afford a 15-year mortgage on the same home, saving over $800,000 in lifetime interest. Strategy 3. The house hacking approach. Buy a duplex or triplex with an FHA loan requiring just 3.5% down, live in one unit and rent the others. Your tenants cover most or all of your mortgage payment while you build equity. After 2 years, you can move and repeat the process or refinance into a conventional loan. This turns housing from your biggest expense into an investment vehicle. Let's run a real comparison scenario. You're 30 years old looking at that $400,000 home. With a 50-year mortgage, you'll own it free and clear at age 80, having paid $1.5 million total. With a 30-year mortgage, you own it at 60, paying $958,000 total. With a 15-year mortgage, you own it at 45, paying $639,000 total. That 15-year difference between 30 and 15-year mortgages represents $319,000 you could invest elsewhere, potentially growing to over $2 million by retirement. Here's what to do right now if you're facing this decision. First, use a mortgage calculator to compare total interest paid, not just monthly payments. Second, calculate your equity position at 5, 10, and 15-year marks for each option. Third, run the numbers on buying a less expensive home with a shorter mortgage term. Fourth, explore whether waiting 12 to 24 months to increase income or savings changes your options dramatically. The housing market will always have ups and downs, but the math on 50-year mortgages remains brutally clear. They transfer wealth from you to banks over decades. If affordability is your challenge, the solution isn't extending the pain for 50 years. It's either buying less house, increasing income, or using creative strategies like house hacking to make the numbers work in your favor. If this breakdown saved you from a costly mistake, subscribe for more real-world financial analysis. Drop a comment telling me which strategy you're considering, or what mortgage questions you still have. Next week, we're covering the hidden costs of home ownership that most first-time buyers completely miss. You don't want to skip that one.